Thank you, Jalupa, and for putting together such a phenomenal event and convening. It's really a pleasure to be here. Brian, I wish we were going to hear your piano playing, but I'm sure you'll do that in this fireside chat in a different form. You have written recently a lot about re-dollarization. We've heard a lot about de-dollarization, weaponization of the dollar, what's happening with BRICS countries. So I'm interested to touch upon that today and really to look at two potential pathways for the future of money, an optimistic pathway or a pessimistic pathway. Before we go into that, I know you want to break down two macro themes that I think will be very helpful for our conversation today regarding decentralization and unbundling. So why don't you touch on that, and then we can kind of break down some of the areas of where the future of money will go in 2050.
Yeah, that's great, Michael, and thank you for the question, and Jalapa and Pat, thanks so much for having me here today. This is always fun, and it's nice to be here in person for a change. So this is amazing. What Michael's talking about is, sort of the driving reason why I ever became interested in financial technology in the first place. There's some people who, after my tenure as Comptroller, saw me as this crypto guy. And what I always try to explain is I'm really not a crypto guy. I came to crypto late in the cycle. I wasn't one of these Bitcoin guys from 2011 or anything like that. The reason I found crypto interesting was because I do believe that there are two long-term inevitable macro trends that are coming for finance the same way these kinds of things have come for other sectors of the economy. And I'll just spend 2 minutes just talking about what those two things are. So one is what I refer to as the unbundling phenomenon, which is what the internet makes possible that previous generations of banking couldn't do. So if you think about what the basic model of an American bank is, and I say American bank because in the history of banking, this is not the only model, but the model that we've all grew up with and has persisted for 3 generations roughly is a model where 3 services are offered together inside of one institution. And those services are deposit taking, payments, and lending. And because we've grown up with this, we believe that's the only way that it could ever possibly be. You have to gather a bunch of deposits in a centralized institution in order to efficiently farm those deposits out in the form of loans. And naturally, anyone who's providing payment intermediation is someone who has to receive the deposits as well as send them out, right? That's what we all believe. That isn't actually what the law says. The relevant OCC regulation on this point talks about a bank as being anything that engages in deposits, payments, or lending. But that's not how we think about it. We think about this as a bundled set of services. And the truth is, until about 20 years ago, that was the only way it could possibly be. The analogy I've used for years is the analogy of the post office. There's no efficient way to operate a postal system where I can send a letter directly from my house to Michael, and someone else in the audience can send a letter directly to somebody else, because you'd have to have an infinite number of couriers at all times going from point A to point B. So the more efficient model was gather all the letters in one place and then farm them out to very small zip codes. So that's the only efficient way to do it. And it was the same thing in finance. That's why we use the phrase money center. The largest banks gathered most of the deposits in one place, and then that allowed them to efficiently allocate capital. But here's the thing, okay, on decentralization, or on unbundling rather. What the internet makes possible is a set of peer-to-peer matching type services. The analogy would be the way email transformed the way we used to communicate by letter. And the analogy here is that the internet allows you to unbundle these services. And so what Fintech, for example, represents is the ability to make loans without gathering deposits, because you can match a funding source in real time with a borrower without ever having to hold deposits on somebody else's behalf. It also made the giant payment companies possible, because you didn't have to be the depository to nonetheless be an efficient remitter of money. Decentralization is a slightly different phenomenon. This is the crypto phenomenon, but this says we don't necessarily have to have a single governance around the transmission of value. We can algorithmically transmit value, and the algorithms can be maintained by a set of nodes that aren't necessarily known to each other. Those two phenomenon, unbundling and decentralization, I think are going to underscore a lot of what we'll talk about this morning.
So it seems like in events like this, we are admiring constantly de-dollarization. We're admiring the problem. Global central bank reserves, as you've written about recently, dropped since the late 90s, and now we're in the mid 50s, and it may go below 50% central bank dollar reserves. So rather than admire this threat, let's start with a proactive question in the sense of re-dollarization, the potential with dollar-based stablecoins could play in this effort. Speak more about this regarding emerging market economies that you wrote. The government may be trying to go around the dollar, but do the people in the country want dollar-based stablecoins on hand?
Yeah, so let's take 30 seconds and admire the problem for a moment, just to frame it up, right? So people will debate whether de-dollarization is a real risk. I'm going to take the yes, it is side of that debate, but you could make other arguments. So the argument that says de-dollarization is a risk begins with the idea that dollars as a share of global central bank reserves, as you say, Michael, have fallen from about 72% in the late 90s to about 59% today. The rise of the euro is largely responsible, but it's not the only explanation for that. And my personal belief is that somewhere between 59% and 50% is the end of the world. Now, I don't know where that is, and I don't know if it's 50 or if it's 57, but there is a number there that seems frightening. That's one case. The other case is there are major governments and major trading partners that are doing their damnedest to de-dollarize the world. Now, they may or may not succeed, but look at the recent BRICS summit as an example of big countries are trying very hard to take the dollar out of the system for a bunch of reasons. Last thing I will just say, and I don't take any side in the political debate, but, when as a sanction on Russia for their invasion of Ukraine, we decided to freeze their dollar deposits, in central banks, what that said is this is actually not a liquid currency. This is actually something that can be turned on and off. The consumer version of that might be the Canadian trucker convoy, right? There are various explanations. Other people will take other sides of how urgent this is, but I think there's at least a reasonable concern here. What the op-ed was about, that Michael's talking about, was the idea that even though there is a government-level attempt in the BRICS countries and a number of other places to change the dollar focus of the international finance system, this is the idea that we either want to denominate bilateral trade deals in local currency, for example, reais in Brazil, or perhaps we want to denominate everything in renminbi, which seems less plausible, but okay. It takes this form, and governments want to do that for geopolitical reasons. But the people who live in those countries systematically demonstrate a strong demand for dollars as the most liquid and stable currency from among all of the fiat currencies. So the question is, what can we in the United States do to support that revolution from below, right? Argentinians would far rather hold their deposits in dollars than in Argentine pesos, for sure. So how do we do that? And the answer is not through the banking system, because it's very tough to get a dollar bank account in Buenos Aires. You will not find a bank in Brazil that will support a consumer dollar bank account. But what you will find are crypto wallets that can hold dollar-backed stablecoins. And that turns out to be a very easy way for somebody in Sao Paulo to have dollars and to hold their wages in something that will be more liquid, right?
So is that your, looking out to 2050, is that your positive view of what the future of money could look like from a U.S. economic competitiveness perspective, that even though you're seeing membership waiting lists in BRICS, people in emerging market economies that may be BRIC members want dollar-based stablecoins?
Yeah. So first of all, I love the way you frame this in terms of an optimistic future and a pessimistic future. I sort of think about this. It's the distinction between Star Trek and Star Wars. Star Trek is the optimistic vision of a future where there's no money and there's a lot of diversity and everyone gets along very nicely with, minor Klingon type exceptions. And Star Wars is the dystopian future where there's an evil empire that just simply can't be destroyed, and we have to have 9 sequels talking about it. So the question is, which is Star Trek and which is Star Wars? So on the Star Trek optimistic view, I generally think that the optimism comes from markets, because markets are just the aggregation of individual preferences around the world. And what we know is most people want self-determination, and most people don't want their wages eroded through inflation or confiscated by evil governments. How do we accomplish that? Well, with respect to our hosts, that may or may not be through central bank monetary policy. I mean, on the one hand, yes, we've had stronger policy here than in other parts of the world, but on the other hand, we just had 9% inflation. So not 100% certain that monetary policy is the solution. But one solution could be stablecoins. And stablecoins, as an example, okay, of a decentralized asset that can be globally accessible regardless of bank constraints, political constraints, et cetera. That's the optimistic case.
So let's talk about the negative case, which I think you spoke about where we are right now, where the problem lies. But how does that continue to grow? And what does the post-SWIFT environment look like, where we read today that China is not allowing its government workers to bring Apple phones to work? So what happens next? What's chapter 3, 4, and 5, and how does that grow?
Do I have to do this in the James Earl Jones Darth Vader voice, or can I just...
Love that.
Oh, yeah. So, first of all, on the point about China and these phones, I mean, American companies don't let their workers bring their phones into China either, so it's kind of ironic. But, the way that I often put this is the successful outcome here will not involve the United States trying to out-China China. And so there often is a discussion I hear in regulatory circles of China has done this, and so we need to hurry and catch up to China. So for example, China has created this ECNY token, which is their version of a CBDC, so we better accelerate our own version of that. And my philosophy has always been that, we didn't win the Cold War by trying to out-Soviet the Soviet Union. We won the Cold War through Mustangs and rock and roll and open markets, basically. And it turns out that in a clash of systems, our system was the more durable, growth-oriented, and resilient. I think the same thing is going to be true here. The dystopian scenario is that we follow China down a certain kind of path, and that is a path that involves us defending the dollar through a series of sticks rather than carrots. Right. So China has Belt and Road, and they sort of coerce parts of the developing world into their orbit, and we coerce the West into our orbit, and we calcify into that kind of a world, which means we have less influence on the largest emerging market in the world because we don't bring China in, we keep them out. That's one thing. And then two, as we do that, we build a set of rails, which will be characterized by our own version of a central bank digital currency that has the same kind of social policies and surveillance policies built into it that the Chinese model has. That's what I really do worry about, right, is that we follow them down that path where money is no longer representative of the aggregation of individual preferences. It's now an instrument of social policy in a balkanized financial system where we retreat to the core.
So when we look at the future of money in 2050, what we're seeing right now in the US and globally is a consumer and a customer that wants optionality. We've seen that with the reason why over 90% GDP of central banks are looking for CBDCs and exploring this, because ultimately the central bank customer is looking for more than just one way to pay. So what does the customer look like in a 2050 environment if we go down a middle approach where it's not a positive, it's not a complete negative, but we're sort of muddling through a middle approach?
Yeah, it's an interesting question, and I think part of the answer depends on who you think the customer of a central bank is. Right now, the only customers of central banks are commercial banks, which is an interesting phenomenon. There is a concept that in a future CBDC world, we'll all be customers of the central bank, and you won't need these intermediaries for normal consumer applications. We'll simply hold deposits directly at the Federal Reserve. I think that's an aggregation of power in a central government organization that is a little bit frightening and possibly inconsistent with our notions of liberty and privacy, but that is a possible world. The middle world, I think, is a world that looks a little bit more like the open banking regimes of the EU and the UK, which is to say, maybe there's somewhat more central bank influence over the way that the system works, and maybe stable coins turn out to be stillborn and they don't really flourish. Decentralization doesn't happen the way that I've described it. But we at least follow an open banking model where better technologies are able to interoperate with what we currently think of as a bank-only environment. There's plenty of precedent for this to begin with, right? So if you went to the UK, you would have access to the payment rails even if you were non-bank. There's a concept of an e-money license, and you can simply be a payment transmitter and you can access the central bank's settlement system. You can't do that in the United States. Only chartered banks, and interestingly and controversially, even some chartered banks themselves cannot get access. Just ask Caitlin Long if she's here today. But only chartered banks can have access to the payment system. I think the middle ground, Michael, is non-bank tech companies can do that so that Stripe no longer has to sit on top of Wells Fargo when they transmit their $100 billion a day of payments. That's a muddling through world where probably we have not achieved Star Trek warp speed, but we're at least not stuck in this weird space today. And we don't have the surveillance state that would come from a fully dominant central bank system.
So, Brian, there seems to be a breakdown between banks and crypto in the regulatory approach between administrations. What do you think is the appropriate fine line? We've heard guardrails more at times than we can speak about. Some say that AI is going to be adopted much faster because the U.S. government doesn't have to do as much as it would need to do with blockchain or digital assets. Is there a regulatory approach that you think is post-partisan?
Well, I mean, unfortunately, I think we live in a world where nothing is post-partisan today. That's just the unfortunate reality. And one thing that's just hard to watch is how crypto has become a Republican versus Democrat issue. Not clear to me how that originated, but it's definitely true today. The debate is basically this. Like, here is the debate between the last administration and the current administration. The current administration's viewpoint, I think, could be characterized as, if you look at Celsius, if you look at FTX, if you look at BlockFi and Voyager and a series of other epic disasters, this stuff is just too risky to be in the banking system. We need to keep it out of the banking system, and banks should not interact with crypto companies. And, when you frame it that way, that is not an unreasonable thing to say. The view, at least that I had and a couple of my colleagues in the last administration had, was you'd be far less likely to have things like Celsius and FTX and Voyager if they were in a supervised environment, right? The way that I've always put it is, the role of the bank charter is not to keep risk out. The role of the bank charter is specifically to bring risk into an environment that needs to be managed in a coherent and clearly understood way. So to me, as long as you, and let's just get specific, I mean, half of the crypto companies in America bank with one of two banks that have a total between the two banks of maybe $7 billion of assets. That cannot possibly be a good thing. I mean, I'm inclined to name names, but I won't. But if you think about, like, the idea that a small bank in Fayetteville, Arkansas, is the main crypto bank in America because JP Morgan just won't touch it because that's what the OCC has said. That to me seems nuts. That seems to me like a recipe for disaster. So again, it's not that I'm a crypto guy and I think there should be a ton of crypto in the world. My belief is crypto's gained wide adoption particularly in certain kinds of countries, but even in this country. And the question is, how do you take something that isn't going anywhere and make it safer? And I think the way to do that is through a system of bank supervision, risk management, liquidity and capital requirements, and other things that are well known and have managed risk well through centuries of financial innovation. Somehow, though, these epic disasters of the last couple of years have been interpreted differently in this context.
So it's clear that we've exited the Gatsby era. We're in a post-FTX environment, and many that you mentioned, and liquidity is at a premium. And so discuss the role of global liquidity pools versus institutional liquidity pools, and how can there be some, I would say, recommendations for making the financial system more competitive in that regard for the consumer?
Yeah, it's a great question. I mean, this brings me back to the unbundling concept I made earlier. So the problem with the bundling approach to banking is that essentially the binding constraint on any given customer's access to credit is the bank's balance sheet or the bank's set of investor relationships. So, when you go to Citibank, you're not definitionally getting access to the JP Morgan balance sheet. You're getting access to the Citibank balance sheet and its ability to syndicate and sell off, loan risk to other people. The concept of global liquidity pools and the reason that people in crypto talk about decentralized finance is simply the idea that, hey, if instead of only having access to a limited number of investors and capital sources, if I had access to an unlimited source of capital and investors, if the internet could simply match me with any number of people that were necessary to fund my purchase of whatever it is that I'm looking to buy, that would be a more frictionless and probably safer way of distributing credit risk into the system. That's the concept. Now people will say, and I've had this said to me many times, they will say, yeah, but we need some wise overseer. We need a credit committee or a board who can be on the hook if something goes wrong. We need that to happen. Otherwise, it's too unsafe. And I come back to the idea of, why do we think that this guy on the bank credit committee is smarter and safer than this guy who's running this decentralized finance application? There's been plenty of examples of corruption, of bad credit decisions, of negligence. The London whale trade lost as much money as all the crypto losses prior to FTX in the entire history of the crypto industry. But somehow we have this intense belief in the value of credit committees or individuals. The point is humans are fallible. And my belief is that you achieve marginal safety increases through supervision and significant safety increases through decentralization where you're less dependent on one person's bad judgment.
So one experiment to look at is what's taken place in the art world. Christie's and Sotheby's, two leading auction houses, they legitimized digital assets in 2021 with Ethereum. And you could buy a Banksy for $12 million, but in Ethereum. So the art market, like the equestrian market, very unregulated, more regulated in the UK than in the US. And this is a market that you've seen be a marketplace for decentralized finance. Is that an experiment that could work in other sectors?
Yeah, well, I think what the art market shows is that value exists in forms that are more and less liquid, more and less regulated, but nonetheless are deemed by the market to have value. Now, you could argue that the art market is essentially a big tax scam, right? Many of the great artworks sit in warehouses and they're just collateral for loans, and that's the way rich people, live on a tax-free basis. You could argue that. And maybe the same would be true of NFTs and crypto in a certain sense. But my point is, the idea that people will exchange value for a physical object that can't be used to buy your Starbucks, and yet nonetheless it's an investment asset, does demonstrate that the concept of money and value is much broader than we necessarily think at a banking conference.
So last question, as you look out at the next iteration of Bretton Woods, where should the next Bretton Woods meeting be held? Given what you spoke about, given the positive, negative middle ground or future of money. And in that regard, how does the U.S. enter that next iteration with the highest form of economic competitiveness, but not in a weaponization format?
Well, I love this as a topic to land on here. In terms of where it should be held, I assume it probably happens every summer at the Bohemian Grove. Isn't that really where Bretton Woods gets updated every year? But in reality, I think it's urgent, and I've been using the Bretton Woods metaphor for a couple of years at this point. It's urgent while the dollar is still dominant that the relevant stakeholders, by which I mean disruptors, not just incumbents, need to get in a room and think about the framework and rule set for a future in which, like it or not, commercial banks will not necessarily control our future destiny. We've known this for a long time, ever since the introduction of debentures and corporate debt in the 70s, mortgage-backed securities in the 80s. The world doesn't revolve around banks the way that it did 100 years ago. And so if we don't start envisioning a financial future that is more decentralized and more technology-enabled, and if we don't do it at a time when the dollar remains dominant, we'll be dealing with a world that is so balkanized that the results won't matter. So hopefully we'll get the memo fast enough.
Brian Brooks, thank you very much.